how underestimated index and exchange-traded funds have overtaken active funds and changed markets forever.
Overwhelming factor has been cost. You don't have to go to an individual fund company. They're on any brokerage platform you go to. It's not much of a margin, but it's a heck of a volume. Vanguard, BlackRock, and State Street between them own about 20% of publicly traded U.S. securities.
It's Monday the 4th of March, and you're watching Markets with Madison. The market share of index, mutual, and exchange-traded funds has officially overtaken that of actively managed funds. There's now almost $10 trillion held in ETFs alone. They've made investing easier and far less risky than anyone in the 90s could have imagined. But they may have also had a structural impact on the way markets now perform.
Stock ETFs,
the ups and downs, the S&P 500 index
have continued to stay strong.
What started off as an investing innovation has caught up to money managers, with the market share of assets under passive management officially surpassing active in January this year. The most popular ETFs track the S&P 500, America's largest stock market, and include a basket of its largest stocks. It's the opposite of direct stock selection, which is what most traditional money managers and investment advisors aim to do. ETFs and index funds are more hands-off, meaning they charge much lower fees. But the low-value, high-volume game has made some of the biggest passive fund managers in the world: BlackRock, Vanguard, State Street, and Invesco. BlackRock argues ETFs add liquidity to markets, but don't affect stock prices, because holdings of ETFs are bought and sold between traders, not the underlying stocks that the funds hold. What these funds have definitely done, though, is disrupt wealth management, making investing much easier for the masses and far less risky. Even Warren Buffett recommends buying into S&P 500 index funds. We've just seen a new wave of exchange-traded funds launched. Bitcoin spot price ETFs have raked in $6 billion since January, one of the most successful fund launches on record. There's now more than 8,000 ETFs available, a 3,000% increase in 2 decades. So does that mean we've now hit peak passive? Well, PwC's survey of executives suggested the market may hit $18 trillion in assets under management or more by 2026. Morningstar's Vice President of Research, John Rekenthaler, was an early believer in the power of passive. So where does he think they'll go next? He spoke to me from New York. John, thank you so much for your time. Lovely to chat to you.
Great to be here, Madison.
You've been in markets for quite a while and actually watched the birth of these exchange-traded funds in the mid-90s. What was everyone saying about them then? Did they not believe that they would become what they are?
Oh yeah, when the exchange-traded funds started in the 1990s, it was with a fizzle and not with a bang. I remember when they came out, I looked at them, and in that sense, I was no more prescient than anybody else. I wondered why we needed funds that traded daily or hourly or minutely, as opposed to a mutual fund that closed, had a price once a day. And actually, the originators of the exchange-traded funds thought they were doing something else. They thought they were coming up with some sort of hedging vehicle for institutions, and they never saw the retail application. So it's one of those serendipitous discoveries, I guess you could say. The 401k plan in the United States, by the way, was the same thing. It was an accidental discovery. However, I will say, although I did not see where exchange-traded funds were going, there was by then at least some activity in index mutual funds in the United States, and that I did think would become actually a very large portion of the industry back when it was just 1 to 2% of the industry. So I will give myself partial credit.
I think you should, because now they're at least 50%. They've actually now exceeded the market share of actively managed funds. So you definitely saw that trend coming. But what about the scale and the strength of these exchange-traded and index funds has surprised even you?
Well, I thought that the overall, counting both exchange traded funds and traditional mutual funds, which, do the same thing. In the United States, they're regulated the same way. So I lump them together in my head. Um, I thought maybe that equity passive funds might be 30% market share. There might be 70% in active funds and 30 in passive. And actually, that's just about reverse now on equity side. Overall, it's 50-50 for the entire industry. And I really didn't see fixed income bond passive funds developing very much. So yes, I was, although at the time I predicted or thought there would be more of a role for passive funds than other observers, I still greatly understated the effect.
What would you say is the largest driving factor to pull more funds into these types of vehicles? Is it purely accessibility? Is it because people can trade on online apps more now? What do you think made the change?
Well, there's two parts to your question. One is what has brought people into passive, and in the United States, pretty clearly, the overwhelming factor has been cost. These funds are very, very cheap. I mean, you could actually buy some index funds that have no management fee whatsoever, 0.00%. You don't pay anything to own them. And the other major funds are almost free, 3 or 4 or 5 basis points. That means 3 or 4 or 5 1/100ths of 1% of your assets per year in a fee. So it's a very small amount. That's been the attraction. And now why exchange traded funds have taken market share away from mutual funds, they both have index funds, is for a couple of reasons. One is the convenience of purchasing them, accessibility. You don't have to go to an individual fund company. They're on any brokerage platform you go to. And the second is tax efficiency. Index funds are tax efficient in both forms, but they're even more tax efficient as exchange traded funds. And a lot of people own these funds in taxable accounts.
So if the value to be made by fund managers on these types of funds is so low, then why are the big guys like BlackRock, State Street, Vanguard going so big on it?
Well, it's not much of a margin, but it's a heck of a volume. I mean, Vanguard is at, I can't even keep track of it. It moves up so fast, $6 or $7 trillion, probably $7 trillion in assets under management now, most of which are passive. So even a very small portion of $4 trillion, as Jack Bogle used to say, is quite a large amount of money. He used to talk about how people think about expressing things in percentage terms. And he'd say, well, okay, 1/2 of 1% doesn't sound very much, but 1/2 of 1% of $1 trillion is $5 billion. Even 5 basis points is $500 million. So that's real money. If you've got $1 trillion fund, which Vanguard does, they're still collecting hundreds of millions of dollars per year on it, even with these very low costs. So it's it's a game of volume now. It's a game of scale. There's a handful of giant companies that are dominating the fund industry in a way that they didn't in the past. It was more of a cottage industry in the past where you had a lot of players, a lot of active managers. Some would have this amount of business, some would have that. Now it's consolidated into these, Walmart-sized companies.
Is there any danger that comes with that domination by the likes of BlackRock and Vanguard? They now own an enormous share of the market that's held in their hands. How has that structurally changed markets?
Well, we don't know, but it's a great question. It's one that regulators are grappling with, observers are grappling with. Yeah, Vanguard, BlackRock, and State Street between them own about 20% of publicly traded U.S. securities. So that's it's about $10 trillion. I always want to say billion, but it's hard to keep my illions straight. It's about 10 trillion US dollars, but they own 20%. 20% market share between the three of them. If they were to get together and exert pressure on these companies, get seats on the board and so forth, there's a lot of, well, I don't know if it would be damage or good. There was a lot of something they could do. And it's being talked about a lot. People are looking at it, but no one quite knows what to do. They're not breaking any laws as they're currently structured. And it's not clear what sort of effect that they're having as such large shareholders, because their conversations tend to be behind closed doors. In general, they're not pushing anything really aggressively as far as we know. But it is something that people are looking at, and eventually, Congress, somebody's going to hold some hearings because their market share just continues to increase. Jack Bogle himself, the founder of the retail index fund, worried about this. He said, what happens if you have 3 or 4 companies owning 40% of the US stock market, 45%, 50%? And, as these companies increase their market share and passive grows overseas, I think you'll even see more scrutiny, partially because some of the other countries are more worried about monopolies or large concentration than in the US, and partially because these are US companies too. And I'm not sure, if New Zealand or other countries want Americans, having such control over voting shares for their companies.
Surely, in effect, we've already seen, though, John, by now, is that there is perhaps some distortion in markets and less market pricing efficiency. Because, as you say, if these beasts like BlackRock and others, they hold so much passively, then there's less direct investors making daily price actions off these companies. Have we started to already see that?
Your question, everyone says surely except for me. So you are in the majority. It's not so clear it's surely to me. It's true that at some point you cross a line when there aren't enough active traders. Obviously, if index funds held 99.99% market share and there were 3 people trading, those 3 people would determine the prices of the entire stock market, because index funds take whatever prices they're given. They don't create them or determine them. But we still have, even as setting aside retail investors, there are still tens of thousands of active managers of various sizes in the US that are trading. We have more chartered financial analysts being the designation for people who are trained in investment analysis. It's like a chartered public accountant is for accounting, a designation. There are more of those now than ever before. So there's still, and if you look at the numbers, there's still, $30 trillion in actively managed hands of in running U.S. equities. So I don't think we're at that stage yet. It's, again, how do you measure that? This is a debate we can have, but nobody really has proof. I don't, and personally, I haven't seen market behavior that strikes me as being different than, say, 10 years ago or 15 years ago. I also think if the prices got that distorted, that should be an opportunity for active managers, and we should see better returns for active managers relative to indexes. We haven't seen that yet. That hasn't occurred. So I don't think we've crossed that point. But if you say, John, you don't have proof, you're right. I don't have proof. And nor does the other side, though.
So what do you think starts to happen next then? Does passive just keep booming and end up taking like a 17 and maybe even 90% market share of these big indexes? Or are we at peak passive and these ETFs start consolidating from here?
No, we are not at peak passive. It's clear from the asset flows that the movement into passive funds, which has been, it's a 25-year movement, and each year it's growing, and this year is no different. It's bigger than it was, if not last year. I haven't looked exactly at the numbers. Bigger than it was 5 years ago, which was bigger than it was 5 years before that, which was bigger than it was 5 years before that. So no, this at least in the near term, this trend will continue. We're talking about this now, and people are scratching their heads and saying how big is big, but there's no great concern. Again, the regulators aren't doing anything. The marketplace isn't changing. Investors aren't changing their behavior because of this. These are all theoretical concerns at this stage. So it's going to continue. I hope it doesn't continue to the point where problems actually do become obvious.
What did you make of the launch of the BTC ETFs? They were quite a success, clearly.
Yes, they were quite a success. We were all surprised it was this long coming. The SEC did not want to approve them. It was clear that the SEC, the authority, was dragging its heels, but eventually would need to do so because it had concerns, but it didn't have anything tangible, concrete that it could point to ban these vehicles. There was a little bit of a slow start the first week or two. We were scratching our head. We were looking at the numbers, and the first week there seemed to be almost as much money going out of Grayscale, which was the existing fund, not structured as a mutual fund, but the existing way that people could own Bitcoin as money coming in. But that quickly changed after the first week or two. There's been quite a flow, and these are going to be big business, and it'll be just the same as with the equity or the index funds. There's going to be fierce price competition. There's the prices are already much lower for people who want to own Bitcoin through a fund than they were, and that's going to continue to go down. It's I guess you'd say it's the free markets operating the way they're supposed to operate.
There's some evidence for you.
There it is. Yeah, the fund industry in general has been a great testament to the power of competition to put down prices and make for better products and services for their customers.
There you go. Passive seems to be winning. Thank you so much for your time, John. Really appreciate it.
Thanks, Madison.
I know a lot of you love an index fund, but if any of you have gotten on the Bitcoin ETFs, let me know. I'm talking to Kathy Wood tomorrow, so if you have any questions about her ARK21 shares ETF, send them my way. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.